Welcome, I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Greg Carroll, where we're here to provide you insights about the markets, planning, taxes, and much more. Today is May 21st, and coming up this weekend, we have a big celebration. We are celebrating Mr. Steve Wolf and his retirement. So for those of you that are joining us, we look forward to getting together and honoring Steve, and there might be a little bit of a contest going on there.
Uh-oh.
The farewell tour continues.
Farewell How long is this going to last?
Right?
I don't know.
It should be fun.
The 2026 farewell tour.
Yeah, exactly.
I mean, the Who had a farewell tour for about 5 years, so I don't know.
Well, he'll probably show back up here. That's my guess.
So as of yesterday's close, yesterday was May 20th, and the Dow Jones was up from last week. We ended up at a little over 4%. The NASDAQ was flat from last week. We ended up at about a little over 13%. The S&P was down or flat a little bit, ended up about 8.58%. And the Russell 2000 at 13.52% was slightly down, but not too much movement over the last week. I mean, yesterday was a phenomenal day. The markets were up pretty significantly. This morning we're down a little bit, and it's interesting because there was a big AI company that reported, and the stock's actually down today after seeing some of those earnings. So we are still seeing earnings. There's still a couple more that are still reporting, so that's still on the horizon. But for the most part, it seems like there's been a lot of the reporting has been done. The one thing we're seeing a lot of movement in right now is the bond markets, and so those are fluctuating a lot. And it looks like the bond markets are telling the Fed that the rates aren't high enough. And so once again, kind of looking at where we're at with the probability of kind of some rate changes. So we're really looking at no change at the next meeting in June. And then by December 9th, the probability of a rate change is about 40 to 50%. With a 25 basis point move. So
up or down?
That one was, I believe that was actually.
Probably got to be up.
Yeah, I believe that was
it's up.
And I'll double check that before we wrap up today. And then the CPI, which we're looking at, inflation's at about 3.8%. Mortgage rates, as of this morning, 6.63% for the 30-year. And 5.96% for the 15-year. So we've seen a slight change, an uptick on mortgage rates.
No refine
right
now.
Anytime soon.
I was going to say that puts the wet blanket. In
Those mortgage
market.
guys are going to be bored for a while.
And then the 1-year CD, which is hasn't been this high in a little while, which it's now at 4% for the 1-year CD. And 3.99 for the 1-year Treasury. So those have come up slightly over the last several weeks. And so once again, the markets have been fluctuating a little bit. I mean, obviously there's still some of the same issues that are still out there in the world and the wars, and but we'll see how long that lasts.
The world's biggest IPO coming in a couple weeks. So a lot of things.
A lot of
happening
exciting
out
things.
There. You know, one of the things you were talking about inflation, and you know the Federal Open Market Committee, you know that Jerome Powell just retired from the chairmanship, and we've got Kevin Warsh in there now. He's going to have a tough job, and one of the things that you know they're obviously looking at is stable prices and full employment. So, you know, with interest rates lately. You mentioned it, Catherine. The 10-year has closed over 4.5% on May 15th, and it's climbed from there. And it's between that 4.5%, 5% where the markets are really going to get a little, hesitant about what that's really telling us. One of the things that the Fed looks at is the 2-year Treasury yield actually moves ahead of the Fed funds rate. And if you look back in February, the Fed's fund rate was 3.62%, and the 2-year Treasury was 3.38. That implies the Fed was going to cut interest rates by 1/4 of a point. And we came into the year thinking we were going to have 2 rate cuts, right? Well, now you've seen a move in the 2-year is just over 4%, 4.08. So that's almost a 0.5 point above the Fed funds rate. So what that's telling us, the Fed funds rate could go up 2 rate hikes, 1/4 point each. So, you know, it's going to be very important to keep watching that. And from, you know, inflation is, creeping up. We've got the tariffs that really is starting to come through the economic pipeline now. You've got the war, so oil and gas going through the roof. I think prices are higher for longer, so I don't see the interest rates going down anytime soon.
And honestly, inflation risk is a risk that doesn't get enough attention. And it's really especially important for people that are approaching retirement
Right.
or in retirement. And inflation risk is the risk that your money loses purchasing power over time. So even if your account doesn't go down, your lifestyle can become more expensive. So this is, really a risk, and that's why being too conservative can actually create that an inflation risk or purchasing power risk.
And that's, a lot of people see it, the price at the pump right now is
Yes.
really hurting us. But, when you're talking about retirement planning, that's, 10, 20, 30 years,
Yeah.
that's going to make a big
Big
difference.
Well, I agree with all the inflation concerns, and you see that in certain areas of the market as well. And as oil continues to climb, you continue to see more and more pressure on the consumer. And it was kind of interesting. You had mentioned that 2-year Treasury rate. Yeah, it was kind of interesting. Kramer, and I'm not a big follower of Kramer, but he was talking about inflation, and he was talking about oil prices. And if oil prices start to climb into the 105 to 110 range, you could see the 30-year Treasury at 5.5%. And he said, if you see that, that's going to really put a big wet blanket on the stock market. And again, the bond market oftentimes is an indicator of what could happen. But what's also an indicator of what can happen is corporate earnings and corporate profits. And somebody, I think, had mentioned the biggest
IPO?
The biggest company that reported yesterday.
Oh.
And they reported
That one.
they had, that one. They reported they had great numbers. They actually guided up. They were talking about how a lot of their, chips were going to be, delivering over $75 billion in forward revenue, and that was amazing. But what's kind of interesting is that when you look at the overall corporate earnings for this Q1, they're all up by about 8.2%. So that's very, very healthy from a corporate standpoint. Now, the issue is that may not be reflecting in what's going on with the extension of the Iran crisis, and now what's going on with the inflationary pressure. So this was prior to. So, Q2 could be a very telltale sign. However, even with yesterday's, kind of move in the the big earnings report from that company, the stock is down today slightly. But, it's sometimes you buy on rumor, you sell on news. But what I've seen over the last and we've seen it probably for the last 3 months, is that investor capital continues to flow into the semi-cap companies, the semiconductor companies, the chip makers, the connectivity companies. And you can make an argument now that some of these stocks are beginning to get, a little overextended. But what's interesting in investors and momentum investors continue to drive these stocks up on any buyback they continue to buy them on any dip in the stock price. So, these prices keep going higher and higher. And the question is, what does the prudent man do? Well, you could take some profits out of these and move into other areas. And the big areas that we continue to mention is what's been underperforming. In the technology area, it's been software, and on the consumer side, it's been retail. And right now, investors, push down these stocks because they thought that, hey, in the software area, AI was going to decimate software names. But, when you take a look at what some of these leading companies are doing, they're actually being now seen as AI user agents. So they're not going out of business.
The software companies.
The software companies. So you can now start saying, hey, maybe I take a little bit off the chip stocks and start investing in very selective, high quality software companies because, they're not going out of business. And on the other side of that, you've got retail stocks, which, again, their earnings reports have not looked good at all. And, the question is, once the inflation fears go away, once the Iran crisis becomes settled, once oil prices return to normal and prices start to come down a bit. Now, I don't know if that's going to be in a month, 2 months, 2 years. I don't know. But consumers will go back to buying. And so, maybe you start looking at some, very interesting high quality retail names. And when you take some money off the, the chip makers and the semis, you buy some high quality retailers. Because again, long-term investors will make money.
So earlier I was talking about the December 9th meeting, the probability of a rate change, and it was an increase of 25 basis points, which kind of ties into Greg's comments earlier. Yeah. Earlier today, Rachel and I did do a little segment on risk, so kind of just reminded me kind of a little bit about back to basics. And one of the things that we discussed was market risk. And so obviously, and it's not just the stock market, it's the bond market, it's cash, it's doing nothing. So there's basically there is risk involved even with bonds. So bonds do fluctuate as well. And earlier, Vince, you mentioned, obviously if what happens with bonds, and how it affects the stock market, what happens is sometimes what we find is some investors, when rates go up for bonds, they start shifting some of their assets from stocks to bonds potentially. And once again, we're not saying to do that. It is case by case. But when you have some investors in the past, when rates were so low that they really were investing in other areas. So it's not uncommon to kind of look at the risk, revisit your allocation. We talked a little bit this morning about kind of risk tolerance and what's an appropriate allocation. And it's not a one-size-fits-all. Everybody's very different, and everybody has a different time horizon, life expectancy, a tolerance for the markets fluctuating and moving up and down. And so, once again, just if you are interested in having us look at that for you, we're happy to do so.
Yeah, risk is a tough one to define because everybody looks at it differently. And like you mentioned, doing nothing is a risk.
Yeah.
Having too much cash is a risk, so
Your behavior is a risk.
your behavior is a risk.
And it's honestly one of the most underestimated risks out there because sometimes the biggest risk isn't the investment itself, it's how the investor reacts to it. So
getting emotional.
people get emotional, they panic during downturns, chase performance that was good last year might not be great this year, or trying to jump in and out of the markets. So there are many different types of risks.
Absolutely.
Well, I have a quick question. I don't know if anybody knows the answer to this, but we've talked around the table about how bond rates have gone up, and typically, you've got that inverse relation. So as bond rates go up, the bonds themselves go down in price. So the question is, does anybody know what the returns of on the bond market is this year?
Like on the ag bond
like
index?
the aggregate. Yeah, is it up, down, sideways, flat? I don't know.
I'm gonna guess it's flat to maybe slightly down would be my guess. But that's a good question.
I was just curious.
Pull it up here.
I was just curious. And
And then once again, there's different ways to invest in bonds. So some investors own individual bonds, some own bond ETFs, some own bond funds, and that does kind of indicate kind of how your return would be because some investors actually own individual bonds. They may hold it to maturity, and it doesn't matter to them that fluctuates because they want the interest or the coupon from that. And then once again, not only there's different types of fixed income and bonds. So there's, the more traditional bond ladder, or there's other income plays that we look at and invest into.
Yeah, the bond market's much broader than most people think.
Realize, yeah.
And to answer your question, Vince, it's down 1.7% year to date.
Oh, wow.
The bond ag, which is an index of broadly diversified bonds. But
I would assume it was down
Yeah.
a little bit. But
Yeah.
So giving you an idea of where we're at with the fear and greed at this time of day. So here we are. As of
Drum
May
roll.
21st, we're at greed at 60. So we pulled back a little bit from last week, but we're still at the level of greed. Once again, markets have been a little volatile, but we're still in positive territory year to date.
Yeah, I mean, we're still near all-time highs. And, there's all this talk about, the SpaceX coming out and then OpenAI behind that, Anthropic, $1 trillion companies going public, maybe 3 of them this year. So I think there's a lot of enthusiasm out there. But if you look underneath, the smaller part of the S&P 500 actually is not doing that well. So the big tech guys and the semis are really driving the performance.
It's concentrated in a very, very narrow band of stocks in a very narrow sector. And, again, that it's great when you're overweighted in that sector and you're, ringing the bell and say, hey, I'm doing great. But, sooner or later, that momentum does shift. And the other interesting thing with all these IPOs coming out with these trillion-dollar companies, that does suck a lot of money out of the market.
Yes.
As investors do climb and pile into some of these.
They got to sell something to buy
sell
this.
something to buy this, yeah. And they want to buy it in size.
Yeah.
There's no reason to buy 100 shares. They're going to buy this in size.
I can't tell you how many clients have called to ask, how do we get SpaceX?
Yeah. Oh, absolutely.
I've got a call this afternoon with a client wanting to buy SpaceX.
Well, there's a stock that has 4 letters, starts with a T. That's one way to do it.
It does own a lot of it. Well, the ticker symbol, I think, is what he's referring to. Not that we're mentioning anything like that.
Leave it to everybody's imagination.
Yep. There you
And
go.
I think that it's also pre-IPO. I know they're putting out the date and all that information. That's why I think everyone's calling on it for.
Right, but
But
yeah,
it's
they're
not trading yet. That's
no,
my
yeah, it's
understanding.
like 2 weeks away probably. So it'll be here pretty quickly.
All right. Well, I think we covered a lot of ground today, and we want to thank you for joining us today. And until next week, thanks for joining.
Thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.